Okay, so to go over the answer to the Power Strategy 1 question on the previous page, let's take a look at the chart that's in question. Okay, so this is the chart. Now what we got to do is identify the trade. So pause the video and identify the trade. Did you get it? This is the ABCD here. So remember, it's AB equals CD. So the move from C to D is equal to the move from A to B. Now, where are you going to be entering? Now, what we're doing is we're anticipating a down move this time. So the move from C to D is where the trade is going to occur. And we're expecting price to go down from point C to point D. Remember, although the chart is actually showing what happened with price at point C as price starts going down, so let's say the first red bar, you're not going to know what price is going to do yet. But what we're doing is we're anticipating that the price will go down from point C down to point D, and that's what we're going to act on. So where are you going to be entering? Pause the video and work it out. So we're looking at the 25% mark in order to enter the trade. So we're going to be entering as indicated. That is 25% of the move from A to B from point C. Going down, of course, because the C to D move is downwards. So remember, when we're going to be entering this down move, we're expecting prices to go lower. So we're going to sell first. We're going to go short. So as indicated here, that is the entry price. When price reaches that point, we're in. We're selling and we're in the trade. What about our stop? Where is our stop going to go? Well, as always, the stop goes outside point C, and in this case, we're looking at a down move, so our stop is going to go above the C point. What about our break-even price? Now, our break-even price is 50% of the move from A to B from point C. So right here, we've got entry at 25%. And we've got the break-even at another 25%, which is the 50% mark. So as indicated, that is the price where we would move our stop to break-even. So when price comes down to this point here, we are going to move this stop down to the entry price. So if price goes up and hits our entry price, we are going to be out. We're going to exit at the same price that we entered. Hence, we're not going to lose any money. We're going to come out at break-even. But in this case, we see that price carries on down. So where are we going to exit? Let me pause the video and work it out. So where would you exit? You're going to be exiting at point D. So you're going to buy back the position because we're going short. So we sold first, so we're going to buy back now. And so we exit at point D for a profit. Now what is that profit and what is the risk reward then? So without working out the exact profit, we can work out the risk reward by working out how many more times is the reward than the risk. So here we see that the risk is 25% and we see that the reward is 75%. Why 75%? Because from point C, 100% down is point D and 25% down is the entry. So there's 75% between the entry and the exit, and there's 25% between the stop and the entry. That means our risk reward is 3 to 1. Our reward is 3 times greater than our risk. Now I'd also like to point out that we've got this ABCD in a down move. The price is nicely trending down. The MAs are generally going down. And so these are the points where we want to be taking our trades for the downside, meaning we want to be shorting the market because everything is indicating lower prices. We've got a downtrend in price and we've got our MAs pointing down as well. So we always want to be going along with them with our strategy 1 trades. Okay, so I hope you got that right. Of course, you can go over the previous module, double check everything, make sure you're fully understanding everything I'm covering in these examples. And if you do understand everything, then please go on to the next page and we'll go through another example.